markets, speculation, and risk. This is the Chat with Traders podcast.
This is episode 251. I'm Tessa, co-host on Chat with Traders. Happy New Year. Happy 2023, everyone. May you have a fruitful trading year and more. In this episode, Ian interviews Kasper Vandeloock, a young and talented arbitrage and quant trader and programmer in the cryptocurrencies market. Kasper received his first Bitcoin at 16 years old as payment for his programming skills. At the time, cryptocurrencies opportunities were emerging, and he followed his strong instincts to drop out of high school to become a full-time trader and dive deep into learning everything he could about this fast-paced new type of finance and medium of exchange. He went on to write his own programs based on delta-neutral arbitrage and order flow strategies. I need to quickly point out that there are two parts to this interview. The first part is a recording we did with Kasper before the collapse of the crypto market due to the downfall of FTX. Since the collapse, we did try to get Sam Bankman Fried back on the show, but it couldn't happen. However, we also wanted to get Kasper to come back on. The FTX fraud, arrest of SBF, and the subsequent collapse of the crypto market opened new opportunities for Kasper, as many players were forced to exit the market. So stay tuned for the second part, which is a shorter follow-up recording. Let's get on to the first part of the interview. Ladies and gentlemen, we present to you Kasper Vandeloock.
Kasper, welcome to Chat with Traders.
Thank you.
Yeah, tell us a little bit about your background. Where did you grow up and where are you now?
Well, I was born in Tienen, then I traveled not really. I moved a lot through Belgium, and I'm currently living in Brussels.
Oh, great. And if you don't mind us asking, how old are you now?
I'm now 22.
22. Okay. Well, get started early.
Yeah, definitely.
How old were you when you first got your first crypto and through what medium?
Well, it's quite easy to count because I'm from 2000. So in 2016, I was very into coding at a young age, and in 2016, I was doing a freelance job, and someone wanted to pay me in Bitcoin. At that time, I've heard of Bitcoin. I originally wanted to mine it to earn some extra money as a teenager, but didn't really have the facilities for that. I got paid in Bitcoin, and I only had two options with it. It was either buy drugs or do something else with it, like gambling, etc. And then I discovered this platform called Poloniex, where you could buy alternative coins like Bitcoin, XRP, Ethereum, etc. Against Bitcoin. And basically it was like a mini stock market. And I was like, okay, this is pretty cool because I was always interested in that. But in Belgium, it's very hard to get started on that. We don't really have something like Robinhood, at least not at the time. You needed to be 18, at least have like 10,000 euros in your account, which I definitely didn't have at that age. And I basically started, playing around with it. I built up some capital from 2016 to 2018 with a crazy bull market, even though that I had, a very small amount to begin with. And then in 2018, I dropped out to become, a full-time trader.
Did you have interest in any other type of financial markets? Did you follow financial news, or were you just kind of thrust into it by receiving the crypto, thereby awakening your curiosity to it?
Well, investing always had an interest to me because I knew that saving doesn't really, help that much to build up capital. So something like investing would be very interesting. And of course, at a young age, I saw The Wolf of Wall Street, etc. So, you see a lot of people with a lot of money is always interesting as a young guy that was broke. But no, before that, I really didn't have any experience. I looked, sometimes at documentaries, etc. But it wasn't like I had a big interest in it at all. That was also not really my start. In the beginning, it was just more as a hobby. And I always wanted to go, further with what my passion was at the time, cybersecurity. But, that quickly changed after 2016.
I see. Did you have early goals regarding crypto through the speculation of it or working other jobs and receiving crypto?
In the beginning, it was honestly more of an experiment. I did set certain goals for me to achieve by 30, which I prefer to keep private, but I've reached those already. So they were also not really realistic. I thought that I would never really hit them, but well, yeah, apparently
Wow.
I did.
Well, congratulations for meeting your goals early.
Mm-hmm.
When you first got into crypto, or the first few years, did you share your early interest or goals related to crypto with family and friends?
Family and friends. Well, I did it because the way that I got started is at the time I think I received like $40. I put $20 into the Poloniex account, and I woke up the next day and I put it into a random coin, and it basically doubled. So that was to me quite surprising. And I remember that I shared it with some friends at the time who obviously thought that it was like a Ponzi scheme and whatever. But yeah, in the beginning, I was quite verbal about it because it was very interesting to me that I had access to a sort of casino where I could speculate on these coins. But yeah, not that much after. Later on, I kept it quite private to myself, just because it wasn't really well received that you were, at a young age, busy with cryptocurrency.
What was the reaction of your family, friends, or even teachers when you quit high school at around the age of 18 to trade crypto full time?
Yeah, at 18, I dropped out full time to do. At 18, I dropped out to do it full time. I remember my dad. He reacted quite well to it. So I ran away at 16. So it's not like I had contact with my mom anymore. But I remember my last exams, I basically, instead of studying for business development that I made a presentation for my dad explaining that I was going to, drop out of high school. And he didn't really have a choice. Like, he either is going to have to support me with it and just accept that I'm going to do it, or that I'll be, that I'll leave the house. That I already found an apartment where I could stay, that I knew I could afford, etc., etc. And he basically was quite. He accepted it quite well. He even said to me, like, "Yeah, I knew you were going to do this, but of course I cannot really verbally support it that you drop out of high school. I'd rather have you finish it first and then drop out. But well, I cannot really stop you." When it came to my friends, they were kind of in disbelief, and I remember I told my teachers a few times that I'm just going to drop out. And, they didn't really believe it. But then the day that I needed to get my last grades, they were in full disbelief when they wanted to register me for another year, that I said, like, no, it's not going to happen. I'm dropping out.
Oh, wow. Did you share with them some of your early successes in trading crypto?
There was a teacher from another school that I shared it with, because he was also interested in economics. He was a math teacher, but he didn't see me at later stages, and I didn't have contact with him anymore. Also, the teachers that I had the last year, I basically, never shared what I exactly was doing. They knew that I was interested in crypto, because sometimes during the lectures, I wasn't paying attention to them at all, especially during computer class. I was, doing my own thing, which kind of bothered them. But no, I never really shared it with them, because again, it especially in 2017, 2018, even though it was in the media, it was still mostly seen as something used by criminals, terrorists, drug dealers, etc.
Yes. So what makes crypto fascinating for you? I mean, what really grabs you about crypto?
Well, in the beginning, especially 2016, 2017, there wasn't really much special about it. But the thing was that it's so open. You can easily get into crypto, especially at the time. You could just create an account without doing any KYC. You could deposit a small amount of money, and you get charged in percentages, not really in standard fees, which makes it attractive for a young person like me. And also the data is just so open compared to traditional markets. If you want something like order book data, etc., especially live data, you're going to have to pay thousands a month, compared to crypto, where it's just like, okay, you have an account here, even though you have $10 or $20 in your account, you can create an API key, request data, and just use that. It's very open and transparent. They don't treat you differently because you're from a different country or whatever. Cryptocurrency just works like it should. There's certain code that the codes gets executed, and there's no regulation in between. Well, now it has, but not back in the day.
In your earlier years of trading, what type of cryptos did you buy?
I mean, the biggest garbage out of all of them. I remember that I was trading one coin quite heavily called Sia coin, which was something that had to do with cloud storage. So you could, instead of mining, you could provide some storage to the network, and then people would rent that storage from you on the decentralized network. And I found it a quite interesting coin because back in the day, you didn't really have stable coins, or at least they weren't big. So all markets were denominated in BTC. And this coin was so cheap. So in the smallest unit of Bitcoins or Satoshis, it was like 60, 67 Satoshis. However, the fees that you paid to take and make from the markets were less than 1%. So for me, it was quite attractive to just constantly place bid and ask on it and kind of do some small market making, but manually to earn some extra money.
I see. So you were more of a market maker / short-term trader as opposed to kind of a buy and hold.
Well, I did buy and hold, but I did a lot of experimenting. I wouldn't really say that I was heavy busy with that. I was in short-term speculation. Market making really wasn't the case yet in my earlier years. My knowledge about markets then was also very minimal. But yeah, back then it was mostly short-term speculation, some long-term stuff. But the coins that I was trading at the time were, many of them were garbage or even outlined scams. But that was what got traded the most back then. So, I went where volume went.
Mm-hmm. I'd like to transition to the idea of the perception of crypto in the media. Frequently, we hear the media and some politicians and bankers frequently say that Bitcoin mining is consuming more energy than some nations, and that cryptocurrencies as a whole are primarily used by criminals for money laundering. What's your response to this?
When it comes to the electricity usage, I don't know the exact numbers. That already, heavily dropped after Ethereum switched from proof of work to proof of stake. When it comes to Bitcoin mining, of course, it still uses a lot of electricity, but I do know that the people that have mining facilities, they go to places where electricity is cheap or where there is too much electricity produced so that they, can buy it for cheap and mine Bitcoin for cheap. So I don't think they should only look at how much electricity gets consumed because of Bitcoin, but also at where the electricity is coming from. Because if it's at a place where they just have way too much energy and they cannot, send it to another place, then, it's quite logical that, why not use it for Bitcoin mining instead? When it comes to that cryptocurrency gets used by criminals, that's definitely true. But you got to keep in mind that with Bitcoin and other cryptocurrencies, you can at least see that it's getting used by a crime. If, for example, a bank gets hacked or there's a malicious transaction on your PayPal account, we as a public don't see that. When it comes to cryptocurrency, there's a public ledger. So if someone is verbally about the fact that, hey, this money just got stolen from me, we can see that actually the money got sent to a different address, maybe linked that to another hacker, etc. So it definitely gets used by criminals because it's fully permissionless. And, it's not like PayPal, for example, can just freeze your funds. But at least we can see, that there is crime. But it's not really appealing for many criminals because you're leaving a trace behind permanently with something like a PayPal account. If, your PayPal account gets closed, that data is deleted, or maybe PayPal still has a copy of that. But when it comes to cryptocurrency, let's say that you steal some Ethereum from someone, you are leaving a trace behind. Even though you are using a mixer or something like Tornado Cash, if that ever, gets traced back to you, you're screwed.
Yeah, so certainly cryptocurrency is not the best way for criminals to keep their transactions private. And I've heard that the percentage of criminal activity using cryptocurrencies has been falling as a percentage of total volume over the years. I'd like to dive into what is quantitative trading on the cryptocurrency market. You're a quant trader yourself, correct?
Correct.
Yeah. Why would we consider quantitative trading over, say, traditional discretionary trading?
Well, when it comes to quantitative trading, the easy thing that you have with cryptocurrency, again, is that the data is so open. You have easy access to order book data, live trades, etc., that you do not have on traditional markets. Shit, I forgot what question you asked.
Oh, yeah. Why should we consider quantitative trading over discretionary trading? The advantages. You mentioned that in the crypto market, is it easier to do quantitative trading on the crypto market than the traditional financial markets?
Yes, it's definitely easier just because the data is so much more open than on the traditional markets. on something like the cryptocurrency markets, you can open an account at an exchange, request the API, and have full access to it with certain limits, of course, but you have full access to the data compared to the traditional markets where you don't have that.
I see. And did you program yourself?
Yes. So before I got into trading, I was very into just scripting as a kid, building small programs, etc. So then in 2018, when I went full time as a trader, I was looking at ways to basically improve myself. And the best way to do that in the beginning was to build tools for myself, things like different methods to enter a trade, analyze my trading history, look at try to build some kind of automated trading strategy in the beginning.
I see. What kind of strategies did you try?
Well, back in the day, it was actually quite simple stuff like trend following, etc. That has now evolved to fully delta neutral strategies and strategies based on order flow. Mostly with order flow, it comes to trying to find trapped players. So players that got into a position are now underwater and aren't in favorable conditions, and then try to make use of that.
So you tried different strategies. How often would you switch between strategies?
It depends from time to time. Some strategies were profitable back in the day. Now, they aren't anymore. I remember in the very beginning, it was on Binance, for example, you had so many different pairs like BTC USDT, but also BTC Ethereum, Ethereum USDT. And between those three pairs, even though it was on the same exchange, you could execute some arbitrage. Now, basically what that meant was, let's say, buy Bitcoin, then use that Bitcoin to buy Ethereum, and then use that Ethereum to sell for Tether or USDT again for a small profit. Back in the day, that was still possible, but these days, that's the competition has gotten too high. You have companies like Alameda, Wintermute, Jump that are now way faster and have a way better infrastructure than me to execute those trades. For example, now it's more order flow based, or strategies that aren't latency sensitive.
So you said you got into arbitrage. So what is arbitrage exactly? Is it just price differences on different exchanges that you're taking advantage of?
Price differences between different exchanges, or also just different trading pairs. So like Ethereum USDT, Ethereum BTC, and BTC USDT. You could use your USDT to buy BTC, then convert that to Ethereum, and then sell that Ethereum on the Ethereum USDT for a higher price, because there was a small difference between those.
I see. And the higher price that you're selling it for, this is between different centralized exchanges, or are you also doing this on the decentralized exchanges?
I've never done it really on decentralized exchanges. I was quite late with the whole DeFi trend. Back in the day, especially in the early days, I did it on centralized exchanges.
How often would you see these type of arbitrages come out to take advantage of it? How frequently would you see it?
Back in the early days, I can't quite remember, but it definitely happened multiple times a day that I saw it on different trading pairs. But the markets were, then so inefficient that you could just arbitrage them out by hand. Especially between different centralized exchanges. Most of the times you could just buy on one exchange and sell it on the other, and you could have minutes of delay, or not be the first one for minutes, and still be able to make a profit out of it. But that was, again, back in the day. These days, everything has gotten so much more efficient, and these types of strategies I don't run anymore, because the competition has gotten real tough, and also the infrastructure of decentralized exchanges has gotten so much better. It's honestly a whole different world now.
I see. So these days, you don't do arbitrage too often, or?
Not when it's latency sensitive. The type of arbitrage that I still do these days is cross-exchange funding arbitrage. Mm-hmm. So a funding rate is basically a fee that shorters pay longs, or longs pay shorters, depending if there is a premium or a discount on a perpetual contract. Now, this premium or discount is different on every single exchange, even though it is for the same instrument. So you could have one exchange like Binance where you get paid to long Ethereum, and then you get paid to short Ethereum on an exchange like FTX. And what I will do is say, if the reward is high enough, long on one exchange, short on the other, and basically make the difference, make a profit on those funding payments. And then also when that spread closes.
Could you describe for our listeners, what is a perpetual contract?
A perpetual contract is like a future contract, but it doesn't have an expiry. So to make sure that the contract price is still close to the index price, so the actual price of, for example, Bitcoin, what we have is a funding rate. This funding rate gets calculated by the average premium on a certain time frame. So let's say that a funding rate gets paid every 8 hours, like on Binance. It would look at the time-weighted average price of that 8 hours, and then if it's, for example, positive, longers would pay shorts that difference, and if it's a discount, shorters would pay longs.
Why does this funding rate differ from exchange to exchange? I mean, why does it even exist in the first place? How does that get created?
Well, the difference in it's quite simple. If there is the index, it all depends on the index price. So this index price is different on every exchange. Why? Because it gets calculated in a different way. So, for example, on Binance for BTC USDT perpetuals, they would say, okay, we're gonna give 50% weight to our BTC USDT spot market, and then 20% on UOB, 20% on KX, 10% on another exchange. While an exchange like FTX could say, oh, we're not going to do that. We're going to give a weight to the Binance BTC USDT market for 20%, UOB 20%, or KX 20%, and basically have a very different, index calculation. And then there's also the thing where, different traders on different exchanges maybe have a desire to create exposure to a specific coin, but cannot go to that other exchange or don't want to move their capital to that other exchange and then buy more aggressively or sell more aggressively. And because you have that different calculation on these index prices, and also just traders on different platforms act differently, you get these funding rate differences.
I see. So how long do you typically see these funding rate differences last for?
Honestly, it really depends, because sometimes it is, just like one funding rate period, but most of the time I try to ignore those. But sometimes it's also days or weeks, especially in the bull market. You saw these extreme funding rates sometimes last for weeks, even though they were crazy fees, simply because there was so much demand and people wanted to utilize as much leverage as possible. So it really depends from market to market. Sometimes it's, one funding rate period, but, those mostly get ignored. But if it's, if it lasts a day, they get noticed by everyone.
So these funding rate differences are created and amplified by a lot of transaction volume that helps push up prices. Is that where the inefficiency comes in? Is it less during a really quiet market?
It's definitely less in a way more quiet market. It is always because of some big events. So currently the funding rates on big coins like Ethereum, like the premium that you pay on these funding rates aren't really that high. I would say like a 2%, 3% APR last time that I checked. But on big bull market, it was sometimes 50% APR. That you were getting paid in a specific direction, sometimes even crazier. I think the peak of 2021 on Bybit, you got paid 2% a day just to be short on Ethereum, which is absolutely nuts, because a guy like me is just going to buy Ethereum, use that Ethereum to short Ethereum, and get a 2% payout every day while actually having no risk.
Wow. You say there's no risk because you're long.
You have no exposure to the underlying assets. So with the specific one that I'm talking about on Bybit now is I use Ethereum as collateral to short the Ethereum contract. So let's say that I had 1,000 Ethereum. I would I would use that 1,000 Ethereum that I had in spot, then use that as collateral to short Ethereum, the contract itself. And then I would bag the payout that Bybit would give me simply for being short. But if it would go up in price, well, since I own the Ethereum, I have no underlying exposure, I would be safe. If it goes down, well, my Ethereum becomes less valuable, but because I'm in a short position, I'm fully hedged.
Mm-hmm. I see. You wrote an article talking last spring about receiving $309 a day for just one Bitcoin. And you're protected on the downside through this delta neutral. How much has this funding rate changed over time? Because this number equates to over 100% annualized payment.
Yeah, but when it's a crazy rate like 2%, it most of the time doesn't last for that long. Over time, like now, rates have normalized again. I personally don't really know what they are at the moment. I haven't checked in a bit. Like now, I'm now checking it on Bitcoin, for example. The best that I can get as we speak is currently 1 BPS every 8 hours, which isn't that special. But also there isn't, a lot of volatility currently on the Bitcoin markets. There hasn't been a big down move or up move for a while. We've been going sideways for almost half a year. So people aren't really, aggressively betting.
I see. So what kind of strategies do you tend to favor during these times of quiet market activity?
The strategies that I currently favor is actually most of the time none. At the moment, I'm busy building further down my systems that I wanted to scale out or start experimenting with new strategies. And I'm basically just waiting on volatility. Now, these days, at the time of this recording, we've received some volatility again, especially on pairs like Ethereum. So I'm trying to, play around that, but that's mostly directional order flow. But besides that, at the moment, if markets aren't favorable, then I'm not going to force myself to trade. And I rather sit back and just try to improve my systems or build out current operations further.
Have you heard of the kimchi premium?
Yeah, I've definitely have. The Korean premium that Sam Bankman Fried and Alameda Research are well known about. You're talking about that one, right?
Yes.
Yeah, definitely. I don't know what the percentages were, but back in 2017 on the Korean exchange BitHump, I think, there was a sudden premium on Bitcoin of over 50%, if I'm not mistaken. And what Alameda Research back in the day did was because it was so difficult to, arb that out from a legal perspective. I cannot really remember what it was, but I thought that you couldn't withdraw your Korean won to the USA or something like that. So what they did is they put people on a plane, sent them to Korea, let them open a trading account there and basically by hand arbitrage it out. But I could be wrong there because it's been a while since I heard the story. But there was a wild 50% spread, 50% premium in Korea that they arbed out.
Wow. So I assume nowadays these kind of premiums, they no longer exist. Has the markets become much more efficient?
The markets definitely have become way more efficient thanks to stuff like stablecoins, better regulation, just overall also market makers now popping up in the space. Back in the day, because volumes were extremely low, it wasn't interesting for a market maker to build out that infrastructure, and especially because exchanges were very flawed. But these days, you don't really see wide premiums like that. If you want to see wild premiums, you would have to go to something like DeFi. But on DeFi, these premiums have gotten way lower, maybe 2% these days on low market coins, but low caps. But no, you really don't see them anymore these days.
Mm-hmm. Have you gotten into DeFi?
I've gotten into DeFi, but not from a quantitative perspective. I have to be correct there. I have gotten into it from the quantitative perspective, but not into stuff like, for example, liquidity providing. So you have automated market makers providing liquidity for them. I've done that by hand, but not really in any quantitative or automated sense. What I have utilized, though, is on decentralized exchanges, you now also have perpetuals, where you can again, with the cross-exchange funding arbitrage, you can get some good trades. I've definitely taken advantage of that. And I'm also now working together with a few DeFi protocols, advising them on how to improve their systems, etc.
Oh, wow. What do you see are the biggest advantages and disadvantages of going through DeFi?
When it comes to DeFi itself, DeFi has advantages in the way that it's just open and free. So like the thing that I already liked about cryptocurrency, that you easily get access to data, etc., that is only stronger in DeFi. There's no more, there's not even private data anymore. Everything is public. You can request as much data as you want. You can send you have no rate limits like you have on, for example, a centralized exchange. So that is very nice. You have better, you have alternative liquidity solutions. So for example, with trading, you have AMMs, so automated market makers, that they aren't really better, I would say, but it's a nice alternative to have. And it's just better, it's, how can I say this? It's easy to start a finance startup on DeFi compared to, anything else in normal finance, because you can just start up a smart contract and start your own, decentralized protocol or decentralized application.
Mm-hmm. Do you ever get involved with NFTs? Any kind of trading strategies?
With NFTs, I'm involved as an investor. I've, taken a few positions. I don't know if I'm allowed to say names or not, but for example, two NFT projects that I like is Miladies and Petite Penguins. Miladies, purely because it's both of these projects are profile picture projects, but what I find interesting is both of them have a very good community. Miladies are more private parties type of situation, while Petite Penguins is more of a wholesome community that tries to help each other out. They also do some interesting stuff with IP licensing. So the penguin that you own, they could utilize that to, have some kind of, how can I say this? What is it correctly? So Petite Penguins, what they do is they could, since the intellectual property is yours, when it comes to Petite Penguins, you also have a wholesome community, but you own the full IP rights to the penguin that you own. However, what you're trying to do is enable that IP. So, for example, try to get a licensing deal with you to build real-life products. So the guy that recently bought up the project called Luca Nets, he has a history with creating toys, gel blasters specifically. What he's now trying to do is try to get IP licensing deals of your penguin to then make plushies with it and sell them to Target, Walmart, and other stores, which, when I heard that pitch in the beginning, I thought was kind of bullshit. But since he has this, good history of already creating toys, one of the best-selling ones in America last year, it gives a lot of hope and makes it an interesting project. They also are now busy with storytelling, like an animated series, etc., and are, trying to create really a unique and interesting approach. For trading NFTs itself, something that I've been looking at is trying to arbitrage them out. So since non-fungible tokens, they're not like a Bitcoin. One Bitcoin is a Bitcoin. There's no difference between them. However, with NFTs, because you have one item of a collection, it's not the same as the other one. It's, for example, with the example of penguins, it could be the one has a crown, the other one doesn't. Difference in skin or fur, background colors of that picture, which causes some liquidity issues. However, now you have these automated market makers like FTX, a SudoSwap, etc., where you always have a bid and an ask. And sometimes these price differences get very big, especially compared to more centralized platforms like OpenSea and LuxRare, where you can execute an arbitrage. But it can be really difficult because trading fees on these NFTs can be very expensive.
For our listeners, can you describe very briefly what are NFTs, non-fungible tokens, and how do they add value?
Well, NFTs, what they are in short, is a sort of unique token, and that can be anything from a piece of art to a concert ticket. Those are the two prime examples. You've probably seen them before, like a Bored Ape Yacht Club or a CryptoPunk. And how they add value really depends from the collection. If it's something like a profile picture, you most of the time get access to an exclusive community. It's kind of like a sign of wealth sometimes too, especially the Bored Apes and the CryptoPunks. I think the cheapest one on both of them is at least 6 figures. So having a profile picture like that, it's just a status symbol, just like a Rolex. The other utility that you have really depends from project to project. Some, like the Miladies, give you access to private parties. Same with Bored Apes. Some of them just give access to, a group chat or part of a community, but it really depends. But the most interesting part for me is just, it's ownership. You get the NFT in your cryptocurrency wallet, and everyone on the blockchain can see that you own that NFT. And it is from that specific contract address. It's not like, going back to the Rolex example, someone sees you with a Rolex, but is it a real Rolex? You don't really know. It can be a super clone, it can be a very good fake. You have no idea. But with cryptocurrency, you can see, okay, that is number, let's say 1,000 out of the 8,888. And we can all see on the blockchain it is from that specific collection that we are talking about. So we know that it isn't a fake. It's truly just ownership, in short.
I'd like to move the conversation to talking about March of 2020, when the crypto and financial markets had a big fall.
The Luna crash.
Yeah. And what happened briefly in March of 2020 with crypto, other than the prices falling? Was there some issue with the crypto exchanges, and have those issues been solved now, or been improved upon?
The biggest issue at the time was, of course, the UST collapse. So there was this cryptocurrency project called Luna, which, think of it as like an Ethereum competitor, but they also had a algorithmic stablecoin. What I mean by that, it's an algorithmic stablecoin. It's a stablecoin, and the peg, so which is $1, is remained by an algorithm that was based on the Luna blockchain. So if UST was below $1, they would use Luna in the treasury to sell for UST, and if UST was above $1, they would use Luna. They would use UST to buy Luna. But back in the day, what happened was that the peg difference got really big, and since UST was, I think, 96 cents when it really started going hard, they aggressively started to sell Luna to buy UST. Now, because there was a DPEG, no one wanted to buy Luna. So Luna got into a debt spiral, and UST never recovered. So many people, lost all their money, and a lot of exchanges had trouble keeping up because, the trading that happened on Luna was so aggressive, which also, brought down every other price. And well, yeah, that's in short what happened.
Great. What is it like for you setting up a quant fund as a young entrepreneur? What was the motivation for you to start in the first place?
Well, for me, I actually originally just wanted to start a prop shop. So I had my own capital, was quite happy with it. And, for me, it was, especially in big bull market, it was always a trade-off of either you trade, you build your systems, or you need to maintain your systems, build it out to newer exchanges, etc. But it was always a game of catch up. So I was like, okay, I need to hire some new people. The moment that I got a bit verbal about that in my friend circle, there was a certain financial institution that said, hey, we would like to create some cryptocurrency exposure, and we would like to do that through you. I thought that it was going to be quite easy to do, start up a fund somewhere like Cayman, and then raise some capital and call it a day. Burned my fingers on that because the financial institution that I was in contact with is very traditional. They cannot just use Cayman, for example. They told me that they could only do it in a fund located in Luxembourg or Switzerland or something like that. They're pretty open-minded with that. And well, that took at least a year to set up. I think 1 year and 3 months in total. And after setting up, it became a problem because there was, I'm sorry, my microphone disconnected. Do you hear me?
Yeah, I can hear you fine.
Okay, shit. Sorry, my microphone just disconnected for a bit.
No problem.
The cable got pulled out.
Great. Do you know anyone else running a quant fund in the crypto sphere?
Oh no, there definitely are. You have mostly market makers, so more traditional delta neutral strategies like Alameda Research, Wintermute, Nibio, Folkfang, and many others. Now you also have Sandcap, which is run by a friend of mine. You have Manifold. There are many others, but there aren't many that do it in Luxembourg, which is quite unique. Mostly, because it's hard to set up there. It's very expensive, and just the legal headache that you have with them is, since Luxembourg is slow-minded and they move slow, it's not something many want to deal with.
So you hire programmers to help you build out your system. Is that correct?
Yeah, I did hire one guy full-time. His name is Munir. Basically, I picked him up right after college. After university, he got a master's in AI and then applied for the job with me. Mm-hmm. And besides that, I currently don't have anyone else, but we're looking to hire someone who has more experience with DeFi pretty soon. Mm-hmm. And also just another senior programmer to speed up our systems, because currently, building out to newer exchanges takes a lot of time.
In your article, you mentioned that you designed your system to be a microservice architecture. Mm-hmm. What is this, and what are the advantages?
think of it as like normal programs, how they work. It's like a stack built on top of each other. It is a one big robot that you build, monolithic programs, it's called. The issue is, of course, with this one big robot is that if one part of the robot breaks, your whole system falls apart, and it can create a lot of issues. While what we're doing is we're building a small army of all different kinds of robots. But if one robot goes down, it doesn't mean that the whole system goes down. And the others can notice, like, okay, there's one system that currently isn't operating, so we can spin up a new instance of it that can replace it. An example of this could be, let's say a risk engine. So I would have my terminal. I want to execute a specific trade as a human. I submit it through my terminal. The terminal wants to go through the risk engine to our API to place a trade. But we notice that there's something wrong with the risk engine. It doesn't respond. There's an issue. There's something wrong with it. In a normal program, everything would just be stuck and you wouldn't know. With us, it would, it sees like, hey, there is no reaction. We spin up a new instance of it. We submit our transaction to the new instance, and then it would, send it to the API and work just fine. And that's with every small piece that we have in our systems.
I see. So this type of design, is it built to be more resilient, say during when exchanges freeze up, or any problems that happens with the exchanges that's occurred in years in the past? Does this help protect you a little bit from that?
Definitely, because if there's like one error, we can spot it more easily. And it's also very important for scalability. So let's say, we have our current systems in place, and most of it is written in Python. But let's say there's something, very heavy to run, which Python is too slow for. We could rewrite that microservice in a language like, for example, Rust, which is way faster, but it takes a longer time to write it in, and we could basically replace it with that quite easily. Just like that, spin up a new instance, but then in Rust, if we have developed it and replaced it, and it would work just fine. Think of it as like a piece of your car. If the engine isn't fast enough, but back in the day it was, we can now just replace it quite easily.
So for your crypto fund, are you targeting individual or institutional investors?
Mostly, technically anyone that is high net worth, but we definitely have a preference for institutionals because to onboard them, it's more easy, and also the minimum ticket size in Luxembourg can sometimes be quite high for angels.
How much new competition do you see entering the field, or is it difficult to track?
It's quite difficult to track because quants like to keep a low-key profile and don't really, shout it out like, hey, we're starting a new quant fund. But most of the competition that we see is more from the VC perspective. So early investors, seed investors, not really people that, actively trade or run liquid strategies. I think this also comes because of the attractive period that we had in 2020, 2021, where VCs, a lot of them just did prey investments, and sometimes they went up by 100 and sometimes they went bust. But VCs, had an incredibly easy time. Then I've seen that friends of mine, but also, competitors are now attracted to that way more than running a traditional hedge fund.
Mm-hmm. So to effectively utilize your strategies, have you calculated roughly what is the maximum amount of money that you could manage and still be effective?
We've noticed that if we keep it below 30 million, we're going to be fine with our current systems, but it's quite easy to scale that up because the issue that we have is just liquidity overall with the types of strategies that we run. Since we are mostly directional, we can manage quite a large sum in overall, but the liquidity, of course, on lower cap coins is, very spread out. So for us, if we want to go above that 30 million mark, we're just going to have to, connect to more exchanges and perhaps also more OTC platforms.
So where do you see yourself, or where would you like to see yourself in 3 to 5 years?
It's a difficult question to answer because if you asked me that question 3 to 5 years ago, I would have said that I worked in cybersecurity. Honestly, I would say kind of the same place where I am right now. Like trading isn't really a thing that I that I'll quit soon. I've tried to quit it in the earlier days or even other periods, but I always get attracted back to it. So I think that I will always, stay in this space, running this shop, especially for Muscat itself. It's something that I want to do long term. I want to do it for at least 10 years, not leave anytime soon. I want to scale it out, actually, not scale it out as not only the fund, but also, building something on top of that. Think of something like a Bloomberg terminal for cryptocurrency, for centralized exchanges and stuff like that, where my expertise is, where I have some expertise. So yeah, I would say that just further with the, building out the fund, advising projects. There are now a few projects that I'm, that are going to be announced soon that I'll be advising. I'm very stoked for that. And honestly, I just want to, stay on that path.
Great. I had one question regarding regulations, and some say that some kind of regulatory framework is necessary for big institutional money to get involved. What's your take on that? Do you think we need some kind of regulation for the big money to come in?
Regulation for the big money to come in? Well, it's hard to answer that question because you have regulation, in the USA, you have that in the EU, etc. I don't really think you need more regulation because at the moment the regulation is already pretty strong, especially, and now especially there's, a lot of work going around MiCA law, for example, in Europe. You have the USA where Sam Bankman Fried is, pushing really hard for regulation. I think it's more of a liquidity issue. At the moment, liquidity has gotten way better in crypto, but it's not like you can, execute a $100 million trade quite easily on the crypto markets. That's going to take days, or at least have, a big market impact on even coins like Bitcoin and Ethereum. I think it's more of a liquidity issue and an overall adoption/interest issue than regulation.
I'd like to move to mindset and psychology. And is the mindset different for a discretionary trader versus an algo trader?
Definitely. Well, for me at least, because when I was a discretionary trader, I had like a more, how can I say, a long-term view around trading strategies. While now as an algorithmic trader, because I'm so into the data, I try to optimize every small part of it. As a discretionary trader, what I did was I placed one single limit order, or I placed one market order or whatever. And that now has become to, okay, how do I, for example, optimize my entry? And it's not only the type of orders that I'm going to use, but also which exchange am I going to use it, which exchange am I going to execute it on? Back in the day when I was a discretionary trader, what I did was I want to trade a 1,000 Ethereum long. I go to the exchange that I use and I execute a 1,000 Ethereum long. These days, it's very different. I have my own terminal. I type in, I want to create exposure to 1,000 Ethereum. And it's going to look at, okay, where do I have money on which exchanges, at which exchange do I have the best rate, so to say, to enter this trade based on prices, liquidity, maybe things like funding rates, etc. And then it's going to execute that trade, but not only on one exchange, but most likely on multiple different exchanges all at once. And with a discretionary trader, for me, I did a lot of manual work. With now as an algorithmic trader, it has really changed to, since I now have way more time, because I automated a lot of my workflow, then I'm spending more time optimizing my systems or building them further out than actually, trading itself.
So what do you struggle with most, and how do you deal with it?
Struggling with most is decide where I'm going to invest my time and resources to. Because cryptocurrency grows so incredibly fast, and you can have the mentality of like, okay, I have this one thing that's now very popular and very cool that I want to expand to, but that maybe not be interesting in tomorrow or next week or next month. So it's constantly a decision of like, okay, am I gonna spend more time building out to this new exchange? Am I going to learn more DeFi related stuff on this specific chain, or am I going to learn options? It's really where you're just going to invest your resources, both time and money wise, because the space just moves so incredibly quick.
Right. There's more things to learn than you have time for.
Yeah, and it's too much for everyone because there's just so much new stuff going on. The last in Arbitrum, for example, is getting very popular, which is like which is a new chain. Well, not a new chain, but well, whatever. It's a new ecosystem, basically. You now also have new memes, which sound very strange to say, but coins like Dogecoin, Shiba Inu, etc. are very big. And now you have Dogechain, which are getting a lot of traction. It's like, okay, is it worth to spend your time on that or not? You're going to have to invest some time in it, perhaps because it's going to get big, or maybe it's just a fad that lasts for another week. But at the same time, you have, I don't know, a new decentralized application that's coming out that's maybe interesting because it's a new derivatives exchange where inefficiencies are created. It could be something NFT related that can be interesting. Maybe a new fraud or a new scam got invented. Maybe you got to spend time on cybersecurity. It's just so much, and even if you have a team, it's a pain in the ass to keep up with.
Yeah. So how did you quickly get to where you're at your age? Did you have mentors?
I didn't really have mentors. I just because all the resources are on the internet. It's, something that fully got invented on the internet. You have all the resources, but I learned a lot through social media, which sounds strange to say, but through platforms like Twitter, private Discord chats, etc., where you meet people that are into the same stuff as you. You talk about it and you build together and you experiment together and you teach each other stuff. And that's, the thing that enabled me to learn quickly. Also, just the thing is about crypto is not only is data so open, but also the founders of these protocols or exchanges are very open. So a lot of the times, like an exchange like FTX back in the day, when they launched, I had some questions about how they designed their liquidation engine because it was so different than anything else that was in the space. I would just DM the CEO, who's now incredibly big, but at the time he wasn't. And I just DM'd him a question saying like, hey, I don't really get this part, or like, why did you design it this way and not design it this way? And I would just get a response. So I don't know, just fucking around and finding out.
Yeah, those early days, you felt like you were part of a community, right?
Now these days too, like especially around DeFi, everything is very open. With DeFi protocols, you can just join a Discord, you can ask questions, and you have people that are paid full time to just answer your questions, or even the community is just going to answer what you're asking for, or send you a link where there's further documentation. With cryptocurrencies, you really feel part of a community. I don't know how it is on platforms like TikTok, etc. I don't think it's, really, I don't think it's going really well over there. But on platforms like Twitter, everyone is very open. Like even big traders that are running way bigger firms than me are just very open to talk about stuff. I don't know how to pronounce his name correctly, Sam Tobacco, I think, but everyone calls him Tabasco, was the CEO of Alameda Research. And for a while, he would just post his analysis after doing the trades publicly on Twitter for everyone to read. And these were very valuable. And you can they're still up. You can still go there and read them.
Mm-hmm. Nice. What kind of sacrifices have you had to make in order to trade and be an entrepreneur? Have you sacrificed on sleep, time with family and friends?
I don't know how in Dutch it's called kluizenaar. So basically like locking myself up for multiple years. So when I dropped out of high school, all my friends were still at high school. They were studying, later they went to university, and I locked myself up into my parents' bedroom. Later on, I did move to a WeWork office before starting the fund. And then after a year, I got Munir, but, I just locked myself up. And, as a psychopath, I was trying stuff out, building stuff out, reading, listening to podcasts, watching YouTube videos, whatever I could to, keep up with the space and try to earn a living out of it. Because, I don't come from a lot of money. So for me, it was either get obsessed with it and master it as fast as possible to, try and make it, or, basically lose it all as in a time investment that I would not make it and could not make it my full-time job and would have to work as a cashier or whatever.
Mm-hmm. So do you end up having any free time to do anything else for relaxation?
In 2021, when I started launching the fund, because the legal work was going to take, originally it was going to take 3 to 4 months, but I got screwed over by my legal team, so it took over a year. But when I started setting up the fund, I decided to, spend 3 months just hanging out with friends, etc., meeting them, eating out, etc. But I don't really regret it or anything like that. I really enjoy my life at the moment. I see, many different kinds of people every week. I eat very good food. I have a comfortable living, so I cannot really complain.
Great. Sounds like you're living the life, living the dream.
Well, some say that. I personally don't think so, but well.
Yeah. So in closing, what would you say to those risk-tolerant equity investors who are curious but scared of getting into crypto?
Take $100, experiment with DeFi, experiment on centralized exchanges, learn as much as possible. If you're young and you don't have the money to experiment, I mean, like, $10 on the Solana ecosystem, for example. Send me a DM on Twitter, and I'll send you $5 Solana where you can experiment with. Honestly, I would just say experiment with it, play around, compared to what it does to traditional finance. Join communities, ask questions. It's such an open space, and you're not really gonna lose anything except the money that you put in. Of course, you could always lose that, but just play around with it. That's what I would say. It's very open, it's very transparent, and there are a lot of resources out there.
Great. Thanks for coming on the show, Kasper.
Yeah, thank you for the invitation.
Yeah. If listeners are interested in getting in touch with you, what is the best way to reach you?
My Twitter is at Kasper Look. So Kasper with a K and then Loock. I also have a LinkedIn. And if I'm not mistaken, Chat with Traders is also launching a platform where I can communicate with them.
Yes, we're launching a community.
So, well, I'll make an account on there, and they can also reach me on there.
Fantastic.
Stay tuned for the follow-up interview coming up right now.
So everyone, we're having this part 2 interview with Kasper just 5 weeks after the first one, due to the extraordinary events that has recently rocked the crypto world. Last time we spoke, Bitcoin was around 20,000 and Ethereum was near 1,600. And just a week later, prices had fallen 20 to 30% due to the collapse of the centralized exchange, FTX, run by the infamous Sam Bankman Fried. Some are calling this the Lehman Brothers event for crypto. Kasper, how have you been during these difficult times?
I've been pretty all right. I did have some significant exposure to FTX, but overall I'm doing well.
Did you have an account with FTX or?
Yeah, I did have an account with FTX. I've been with them since the day that they launched. I really liked their product. And, I was personally hit with my personal assets. I did move off a lot of my activity over the last few months since I had some issues with the exchange. But it's sad to see a player like that go. But it's also, eye-opening to see what kind of business that they were running.
Yeah. Can you describe for us what were the reasons for the collapse of FTX and its impacts on cryptos, NFTs, borrowing and lending, and decentralized finance?
So in short, what happened was you had FTX decentralized exchange, but Sam Bankman Fried also had his own trading company called Alameda Research. And Alameda Research apparently went bust. And to cover that, what they did was they used customer assets to trade with their prop shop called Alameda Research. And that didn't really go too well. And they lended a lot of money to fill the hole on their balance sheet of FTX with their own tokens. So they were taking out loans against FTT, the FTX native token, against MAPS, against Oxy, against Serum, which were all very illiquid tokens and where they held the majority of the assets of. And a big exchange called Binance discovered that, and the CEO noticed this and decided to sell his shares of the FTT token, which caused the price to collapse. And all the lenders asking for their money back, and FTX couldn't provide that money because they lended it all out to their trading firm, which also lost all the money. So there was basically a bank run.
My understanding of FTX as a centralized exchange is regulated, right?
Yeah, they were regulated. You had FTX US and you had FTX.com. However, there were some malpractices going on and it wasn't really a good oversight. And SBF was also one of the bigger sponsors, politicians in the USA, was really trying to push some bills. So everyone was trusting him on that end, while it wasn't really in check. They didn't even have a CFO apparently.
So after the FTX collapse here about almost a month ago, what were its impacts on cryptocurrencies, NFTs, borrowing and lending, and decentralized finance?
Well, borrowing and lending was already in a pretty bad state because there was uncollateralized lending was really popular. But after the Luna crash, because of players like Three Arrows Capital, that industry wasn't already doing well because a lot of people realized like, hey, a lot of these companies don't have their risks in check. So there, nothing major changed. Like some companies did go bust that had some loans open because they had a significant exposure to FTX. But the crypto market itself, the market pretty much nuked. Overall, there was 20-30% downturn on most coins. But coins that Alameda was heavily invested in or was active in had it really tough. Coins like Solana went from $30 to $9. Now it's currently back at $15. Their native token called FTT went from $30 to I think $1.5 right now. Tokens like Serum went from $2-3 to I think 20 cents at the moment. And that's still really high. Serum is their decentralized exchange token. So think of it as like a centralized order book on the blockchain, which was pretty, new back then on the Solana ecosystem. That project has now been forked because a lot of the players that are building on that project realized that, Alameda was only doing them more harm than good and are now, trying to build an alternative.
Mm-hmm. What about the big decentralized players like Uniswap, for example? Were they impacted significantly by this decline, or did some people argue that most of decentralized finance continued to work reasonably well despite the collapse of centralized player FTX?
Decentralized players were thriving at that moment because everyone was looking for alternatives, and especially decentralized alternatives, since they a lot of people had trust issues now with centralized exchanges. So players like Uniswap, GMX, Bird Protocol, Zeta Markets, etc., were all doing really well because of this. You can now also see that centralized players are feeling the heat and are feeling forced to show proof of reserves, so proof that they actually have all the assets that they claim they have on the exchange itself. But decentralized players are benefiting greatly from this, and you can also see that in volume.
Have any of the strategies you have been using been impacted?
Oh, yeah, definitely. FTX was one of the exchanges that I had implemented into my systems, and I really liked using FTX. It had a very clear UI. It had some very unique aspects like the non-USD collateral system. So you could use coins like Bitcoin, Ethereum, and others to trade certain assets with a certain float. So if I recall correctly, if you had $100,000 worth of Bitcoin, it was calculated as $95,000 that you could use as collateral to trade perpetuals, and that was something really nice, especially for hedging, etc. It was a big deal to me. Their funding rate system was also very interesting. Most exchanges pay out a funding rate every 8 hours. FTX did it every hour, and they just had a very simple and clean API and user interface. They were also one of the few exchanges that supports fixed API, which is important to market makers. Not something that I use personally, but a lot of my friends are missing that, on FTX and other exchanges.
That's a shame that all this happened. So are there any other centralized players that come close to making up for the collapse of FTX? Can you do your strategies through Binance, for example?
Yeah, I mean, most of my strategies I can run on other exchanges. I've personally integrated with 4 other exchanges, and I've now integrated Coinbase too, to make up for for what I'm missing at FTX. But you can definitely run these strategies on other exchanges too. But it's you're definitely missing one of your major key components in your systems. Especially, I like to use FTX for directional trading because you had that hourly funding rate. liquidity wasn't always too great on FTX, but it was a very good user experience. And I had very low fees there. I had a good connection with the team. So if I had ever any issues, I just contacted them directly, which is not something that I have with every exchange. I have it with Binance, I have it with Bybit. But exchanges like Coinbase, they demand a lot more volume every month before you can get to a level like that.
In the last month, have many other players left the space, creating potentially more opportunity or less opportunity for you?
For me personally, there's a lot more opportunity at the moment, since Alameda was one of the biggest players in this space, and also a bad player in a lot of ways, which is now removed. There are a lot of trading firms that are down or simply closed their doors. There are now rumors going about Amber Group. The CEO recently died, that they aren't paying their workers and that the seniors are missing. So there's now definitely a gap for traders like me, which I'll definitely take advantage of.
Have you experimented with any new strategies since the last time we talked, or are your the strategies that you have been using, you're saying they're creating more opportunity now because of the exit of some players?
I'm not really running any new strategies. I've simply, first 2 weeks after at the FTX stuff happened, my focus was simply, okay, what is currently going on with FTX? Is there any chance that I will be getting my money back? Quickly realized that wasn't the case. Removed FTX from my systems. Checked if there were any errors caused because of it, to see later on if there's another exchange that is having issues the same way that FTX caused it. Will that interfere with my systems? Wasn't really the case. Besides that, I've been busy developing some stuff and looking at some new arbitrage opportunities, but I haven't executed them. I think I'll be doing some live tests the 8th of December, but I still have to wait a little bit for getting some more data.
Leverage has been a big topic in the crypto universe. How often do you use leverage in your strategies?
Leverage, to me, I use it if I don't have enough collateral on a specific exchange, but I have it somewhere else. So let's say I want to create a long position on Qcoin, but I only have 100K there, but I want to create a 200K position. I don't mind using 2x leverage to enter that position and then move 100K capital from, let's say, Binance to Qcoin. But for a lot of players, they simply use leverage to get naked into a position to create more exposure. Besides that, a lot of people use it to limit their exposure to a specific centralized exchange. So in the case of, let's say, FTX, I knew a lot of my friends only had 10% of their capital there, even though that it was their main exchange. And then they simply use 10x leverage to trade that specific asset that they wanted to do while having their counterparty risk limited.
So there's been a lot of horrifically negative sentiment in the news today, in recent days and weeks, regarding crypto. Last week, the European Central Bank said that crypto is on the road to irrelevance because Bitcoin is rarely used for legal transactions. Its impending regulation is misunderstood as approval, and its promotion bears reputation risk for banks. Bitcoin transactions are cumbersome, slow, expensive, and have never been used for any significant extent for legal world transactions. Any thoughts on that statement? Why do you think they want to make that statement if it's on the road to irrelevance?
I find it strange that they make that statement because I have a few friends that work at the European government and work at some financial companies there. And what they're telling me is that, for example, the central bank and some financial institutions from the government are giving out DeFi lessons, so how to work with decentralized finance. And that, that you're looking for a lot of crypto native people at the moment. I know that they're trying to improve their laws by 2023, which I think is going to be delayed to 2024. There was recently also a new law that they wanted to implement around stable coins, that, you're limited to, it was something related to like USD stable coins versus Euro stable coins, but I can't really remember what it exactly was. And when it comes to Bitcoin, Bitcoin still gets used for legit transactions. The thing is, if you see a transaction on the blockchain, it's very hard to know if it's for a legal use case or illegal use case unless you know one of these addresses that is related to a specific crime. I personally use Bitcoin to pay for stuff sometimes, like gift cards, etc. Or if I have to pay, for something online in general, because my credit card is acting up because it's, it's a strange country that I'm buying something from, even though it's just an online subscription or whatever. For me, cryptocurrency is overall easier to use. For Bitcoin itself, it's hard to really say because I don't really use Bitcoin that much anymore. I'm more of an Ethereum and Solana guy, because it's faster and you can interact with smart contracts, etc. But the statement doesn't really make sense. But it's also logical that you're going to talk badly about a competitor like that.
Do you think that it's much better to talk about the specifics, the pros and cons of each type of cryptocurrency, instead of just lumping it all into one basket?
It's kind of difficult to say because I'm really pro crypto, but on the other hand, if I was in their shoes and I would have to address the public, the average Joe, I would not advise the average Joe to get into crypto simply because there are so many scams and so much can go wrong, and it's more for for tech native people to get into, or for investors that are looking to really speculate on certain markets. So if I were in their shoes, maybe I would also make a statement like that, not really saying that it's fully irrelevant, but give more warning signs, try to get people to stay away from it unless they really know what they're doing. But saying that it's irrelevant, isn't really a valid opinion. If you're giving out DeFi lessons, etc., and are looking for crypto native people to work for you, that means that it's definitely here to stay. I don't know. It's the banks make so many strange statements all the time, and I didn't really follow it up over the last few weeks what they exactly said, so it's hard to give an opinion about it.
Some people are saying that there's some talk on the regulatory front that exchanges would make users pass a test before they could enter DeFi, so that they have basic understanding of the risks that are potential in DeFi. Would you support that kind of regulation?
Depends on how far it goes there. I don't really know how they want to implement it. Like, do they want to implement it in the user interface of a website? Like, let's say that I have to go to Uniswap, that I have to fill in a quiz before I can actually use the protocol. I find that, a little bit hard to implement, since, how are you going to check if this person already did a test? Are you going to link it to a certain wallet? But then you have to, somewhere store that information. Are you going to log it by IP address? There are so many questions around it that I find pretty difficult. I would rather not see it happening, but I wouldn't be surprised if it would, because you already have it with some cases like futures trading and perpetuals trading. If you go to Binance and you create an account there, before you can trade futures, you have to fill in a quiz. So I wouldn't find it strange if certain protocols, if you use their user interface online, like GMX, would actually ask you like, hey, this is how our systems work. Are you aware of that? What the risks are, et cetera, et cetera. I would find that kind of logical, but on the other hand, it's a decentralized protocol, so you cannot really, there aren't really any laws when it comes to, crypto itself. I think it's very hard to implement, especially because are you going to do it in user interface? But if someone forks that interface and then just removes that quiz, how are you going to stop it? It's kind of like saying we're going to, force you to do a quiz before you can use a cryptocurrency wallet. It's all open source, so someone can just fork it and remove it without an issue.
Mm-hmm. Yeah. So turning to sentiment, right now there's so much negative sentiment regarding crypto, and some prominent people in the investment field are saying, sell all your crypto. For example, James Cramer, the head of CNBC, is saying, sell all your crypto. And recently we had a front cover article on The Economist saying, the downfall of crypto. Do you ever look at contrarian indicators like this as possible early indicators of we're getting near the bottom?
Well, if you look at Jim Cramer, his tweets, and you put them on the Bitcoin chart, then it always does the exact opposite of what he says is going to happen. So I'm very happy that he is bearish on cryptocurrencies, and I hope he remains like that for a couple of years. When it comes to The Economist, the downfall of crypto, everything that has happened is actually just an indication that there is actually need for crypto, because cryptocurrency is all about decentralization, transparency, and being open. The reason that we use centralized exchanges is just because the liquidity currently on decentralized exchanges is pretty bad. It's pretty slow, and there are some privacy concerns when it comes to a wallet address. You can look into it, you can see what kind of positions it has, open orders, etc. on a decentralized exchange. However, on a centralized exchange, you don't really have that case. However, you do lack all the aspect of it's a centralized party. You don't really know where your money gets placed. This is just a sign that we actually need to work more on decentralized exchanges and bring those really forward. And I think it only shows that we really need crypto more than ever. Saying that it's a downfall of crypto, I think is a very bad sentence to say. I would say it's a downfall of SBF more than anything.
Given the blowups that we've seen with FTX, Celsius, Voyager, and others, how do we improve the crypto ecosystem to increase stability and trust in the centralized and or decentralized exchanges?
Well, when it comes to centralized exchanges, I think stuff like proof of reserves and just having a good auditor, maybe having multiple auditing firms that are doing regular checkups would be something nice to see. FTX apparently did do audits, but only once a year, and there were higher ups that could tamper. Apparently SBF had some kind of backdoor into the accounting system that the CTO Gary made for him. So that is fairly hard to spot, but I think if we have more regular audits from multiple accounting firms, that would be something very nice. Having stuff like proof of reserves would be very important. And when it comes to players like Celsius and Voyager, the suspicious thing about these players is that you don't really know where the yield is coming from. They were promising yields of 10 to 20% on stablecoins, which is utterly insane. And people didn't know where it was coming from, apparently from big players like Three Arrows Capital. But I think if you provide some kind of yield on a centralized exchange, I think it's very important that you know who your counterparties are. With players, like Binance, etc. If you want to lend out your money, you know who the counterparty is. It's another trader that has collateral on Binance and will get liquidated if he's not able to pay that back. However, with players like Celsius and Voyager, you simply don't know who that is. And it's very hard to calculate your risk if you don't know that.
Mm-hmm. Yeah, so there's been some positive movement toward releasing proof of reserves, but the critics argue that, well, what about the proof of liabilities? Because unless you know what the liabilities are, that showing your proof of reserves is only half the picture.
Yeah, I fully agree with that. But when we're talking about proof of reserves, I just mean like the assets, the assets that they have, and the liabilities, of course, as is what they owe to users, etc. But I personally don't know how they're going to approach this problem. I personally haven't, been too deep into it yet on how they could actually build a solid system around that. So I cannot really go further into that.
What are your thoughts about whether we need a decentralized algorithmic stablecoin, such as an alternative option to the centralized government-influenced stablecoins like USDC and USDT? Supposedly, Aave is designing a stablecoin called Go. That's algorithmic. What are your thoughts on all of that?
I try to avoid algorithmic stablecoins as much as possible. I mean, we've had some tries in the past. It's true that Aave and Curve are both now building some kind of stablecoin, but they released some kind of light paper, but I haven't really, dig too deeply into it. But I personally don't really have an issue with centralized stablecoins as we have it right now. I think coins like BUSD, USDC from Circle, USDT from Tether, they're working fine as is. You already have some kind of algorithmic stablecoins that are working, like DAI has been a very strong contestant. You also have UXD, which is a stablecoin on Solana that I find very interesting. So what they're doing is create a stable coin, but it's backed by delta neutral positions. So they would go long Ethereum somewhere and short it somewhere else, do a potentially cross-funding arbitrage or something like that. And those positions would then be the collateral for those stablecoins. But when it comes to the Curve stablecoin and the Aave stablecoin, I haven't read the documents yet.
In Europe, do they have certain disclosure requirements regarding the use of leverage? When and how much and to what degree?
It depends. I'm limited to my usage in Luxembourg, but how it is with me is in my offering document, I stated how I exactly use leverage. I go into the types of strategies that I use, how I use them, the risks that are involved. I personally just put the risks of everything to the max because I didn't want to fiddle around with how riskful is it really. I just put the risk on the highest. I explained how I use leverage. And when it comes to, providing proof that I actually have these assets, I have to go to my CPA every quarter to do a NAV calculation. And they go over every single order, every single transfer, every single payment I have done, individually to actually do these calculations. And then they, make up a final document that I can send to, my investors saying if their share prices are up or not. I don't really know how it works in places like Cayman, etc. So it's hard to form an opinion on that. My system is at least very transparent, and that's a good thing, especially now, since a lot of players didn't care about that 2 months ago. But I personally don't know how it would be in other jurisdictions.
I see. Great. Is there anything else you'd like to share with the listeners?
If you have any other questions about the FTX stuff, about me, or just want to have a chat, you can contact me on Twitter. My handle is @KasperLook, which is KasperLock, or you can contact me via the Chat with Traders community.
Fantastic. Great having you on for a part 2 catch-up, Kasper.
Thank you.
Great.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.